Good morning, everybody, and welcome to this week's weekly analysis session for the Elite Traders Club on Monday, the 19th of October, 2015. The year is certainly flying past. It seems now the volatility of the markets, even though that was at the end of August, about 6 or 7 weeks ago now, still certainly fresh in everybody's mind. So let's go and have a look at the markets and see what we can make of them for this particular week. Good morning, Michael. The disclaimer, first and foremost, the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, or particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, so today's agenda, as per normal, going to go through and have a look at the portfolio management. This particular week there has been a change in the US. We'll also go through and have a look at some specific setups. I will talk a little bit about the education session last week that I ran on Wednesday. It was actually a recording. I had a couple of things that I had to do on Wednesday afternoon, so I did a pre-record of that. That's now available in the education tab of the Elite Traders Club portal, so please make yourself aware of all those education sessions. There's a long list of education sessions now. They're not just topics that are specific to your trading plan per se, but they're additional educational content as well. So certainly something in there for everybody, no matter what level of experience you are. Also, this particular week, as we go through, we'll have a look at some of the new setups in both markets. Very limited at this point in time. You might remember that with the big market sort of purge, if you like, during the end of August, beginning of September, the observation obviously clearly that the market had gone through a severe bout of volatility, coming down very, very strongly, only to sort of bounce to the upward side, then rebound to the downward side, and now starting to move to the upward side again. So still lots of volatility in both markets at this point in time. But the comment at the time, the observation was that it's going to take a fair amount of time, because we're based on weekly charts, for the market to regain its composure and for us to see the right sort of price action that we're really looking for to enter our trade. So the market's taken a little while to do that. There are certainly signs that if you look at a number of charts now, that we're starting to get better price action in a number of charts, but still not yet the number of opportunities coming through that are meeting all the filters that we put upon them. So let's go and have a look at our market risk at the moment. In the ASX, we're still in very high market risk at this point in time, so therefore remembering we need to use a market risk multiplier of 20%, so 20% of our maximum value at risk. Now, for most people, that's somewhere between 10 and 15%. In the US, the market risk there has changed. It's actually improved slightly. Last week, you might remember, we were in very high market risk. We're now up to high risk, and there's a little mistake there. That market risk multiplier needs to be changed as well. It needs to be changed to 40%. So please make sure you think about that as well. So that's my mistake there, not updating that 20% to 40% there. So what does that mean? Basically, it means that if you are splitting your capital between those two markets and assuming you have a maximum allowable drawdown of 15%, it means you would basically split your capital between the two markets, meaning 7.5% maximum allowable drawdown from either of those markets. So your Australian component of that portfolio means that you are only allowed to risk at this point in time 20% of that 7.5%, which would give you a total exposure or total value at risk of 1.5%. Conversely, in the US there, we're in high market risk, so we use a 40% market risk multiplier on the other 7.5% of the maximum allowable drawdown, giving you a value at risk at the moment in the US of 3%. So remembering, again, if you've been in the market for a period of time, again, your job when the market risk conditions change is to continue to manage your trades in the appropriate way. Given that the trades that we're picking all have good relative strength, then the concept is that those stocks should hold up a lot better than the broader market, and indeed both of the watch lists have actually held up very well despite significant increases in volatility. Now, it doesn't mean that every stock has done that. Certainly there have been a number of stop outs, particularly in the US, with some extreme volatilities coming through that particular market, but by and large the portfolio, the watch list in both markets has held up quite well. All right, just a reminder, your macroeconomic session's on Friday afternoon with myself and Jeff, so hopefully you're getting some benefit out of there this week. There's not a lot of data coming through on the markets this week, a fairly quiet week. We certainly talked a little bit about, on Friday, what had been happening in China, movements of or discussions that the Fed were having at this point in time, and the general broader consensus that the Fed really going to be sitting on its hands until probably into the new year. And whilst volatility is still high, certainly it's starting to reduce with the market starting to factor in that interest rate hikes in the US are a little bit further away now. All the fear, etc., associated with China for the time being seems to have dissipated as well. So certainly make yourself known to those sessions and see if you can take the time. Most of them are only around about 15 or 20 minutes just to get a bit of a broader update and particularly get a little bit of an insight into some of Jeff's expertise from all things fundamental in nature. All right, let's go across to the markets now and have a look first and foremost at our key market risk indicators. Now, what I've done here on this particular chart, the chart of the XJO, our ASX 200, down the bottom there, I've just put in the little histogram. In fact, I might even change that a little bit. Those of you who caught up with the education session would now know how to place this indicator. This is just a percentage volatility indicator that I've placed on the bottom of this, the broad market benchmark indicator. So remember our stochastic, the worm, if you like, that we use to help monitor market risk. Just another bit of confirmation, if you like, in terms of understanding how the market is moving. You can add this volatility, this percentage volatility indicator. And what I might do is I might just change this a little bit just to make it a little bit more evident. So I'm just going to make the width of the histogram bars on the bottom a little bit thicker so we can see that this green patch, if you like, the green grass, is a measure of market volatility, and you can see that over a period of time it's been increasing. This little red line here is just a longer term moving average of that market volatility, of that percentage volatility. And I think it makes sense to, again, just for confluence, if you like, confirmation, second opinion, call it what you like, to have a measure of volatility showing up on your market risk indicator chart as well. So I think the key observation here is that certainly the green line that we've got on our benchmark indicator is a longer term moving average. That's just a 200 period moving average, so an exponential moving average. And typically when price is above that, we are in bullish mode. When price starts closing below that and we get a series of lower closes below it, we're in bearish mode. Our benchmark indicator tells us by way of moving or oscillating between 100 and down to 0 levels of market risk. So we associate, depending on where it is on this scale, different levels of market risk, and many times we talk about the significance of this 60 level as being almost a tipping point, if you like, in terms of the likelihood, if you like, for further downward movement. Once we get below this 60 line, the propensity, the likelihood for the market to slip away increases certainly fairly significantly. You've only got to go back over a period of time to see that. Doesn't always mean that it's going to happen, but certainly it's a key level that you need to keep a bit of an eye on. The other aspect of when you look at this is with our volatility indicator, you'll see at this point in time that the green grass, if you like, has started to grow above the longer term moving average of the volatility itself. So we can see the volatility is starting to increase over a period of time, and at the same time, so what that's meaning is that we're starting to get bigger daily fluctuations in the ATR, both upwards and downwards. Remember, volatility is non-directional. But what we're seeing through our oscillator is that market risk is increasing, the overall price is trending to the downward side, and we're getting an increase in volatility. So certainly adding up towards a riskier type of environment. I think it makes really good sense to be using that in conjunction. Certainly of late, you'll see that volatility has really started to outstrip or surpass its longer-term moving average. And, we had these big up and down days more recently over the course of the last few months. And just recently over the last week or so, you'll see that volatility has started to taper off a little bit. And that's pretty evident as well through the size of these candles. Certainly not nearly as large as through the prior sort of 6 to 8 weeks in particular. So certainly I think makes good sense rather to incorporate that to give you a little bit of a view of overall market risk, and giving you a little bit more consensus, if you like, and a little bit more of a feel for what's happening in the markets, and therefore your respective position in it. So how much of your capital should you be having exposed to the market, keeping in mind that we've got a market risk indicator that helps to do that, but also in the background keeping in mind that we've still got lots of volatility in the market, which makes for difficult trading. And remember, trend following works best under a lower volatile type of market regime. So that's in the ASX 200. And you'll see on the right-hand side here, the volatility at the moment, 1.55. So effectively that means that the daily swings up and down are 1.5 times its average movement over the longer term. So that's quite a degree up and down. So that's on the XJO. And again, as it says, still in very high risk mode at this point in time. Be interesting to see what happens when we get back up to this longer term moving average, whether we can get some meaningful closes above that, or whether we rally back up to there and then start to move back down. Conversely, let's go and have a look at the US. So the US, if you like, the percentage volatility over there, 1.39. So that compares with the ASX back at 1.556. So who would have thought that the US market is actually less volatile than the Australian market? But that's the benefit of having a percentage-based volatility indicator on the bottom there. It just enables us to compare apples with apples, so to speak. The significant change is that the market risk indicator is now well above 40. We're getting closer to moving up into sort of that. We're in high risk at the moment, so we can start getting up into sort of moderate and then low risk if the market keeps moving in the right direction. This little square up here, this is still the dominant candle in terms of Japanese candlestick theory, so we've still yet to challenge that particular level. We do have this old ceiling here, which we've come up to and tested a couple of times in the last couple of months. Certainly first test, we've come up to the second test, we've had a nice little shallow retracement, we've come back, we've just closed above there the other day, and I'll just move a little bit to the left there so you can see that, and we've managed to close above that level. So that's quite a good sign, even though that last candle was certainly not the same in terms of strength as the previous one, but moving in the right direction. We've still got to come back up and challenge this previous candle up here, which is still the dominant one. Interesting that if we compare the two markets, the US much closer to its longer term moving average. We're right at it now, given the fact that the Fed looks like sitting on its hands until the end of December into the new year at this stage. So sort of foregoing any broader macroeconomic hurdles in the path of that, then I tend to think that the market should, over the course of the next few weeks, move back above this. So we'll just have to wait and see. Certainly, in terms of fear factor and those sorts of things, there's nothing in the US at this stage that's looking to upset the apple cart in terms of interest rates at this point in time. Certainly the economic data out of the US has been very mixed and continues to be very mixed, and I don't see that changing anytime soon. At this stage, over in the US, I ran after running all the scans. I was only able to find one clean setup, even though the scan itself threw up around about 300 odd results. In terms of our price action filter, there was only one really nice, clear, clean setup, and that was on BG Foods. So let's go through and have a look at this one as a setup. You'll see that it's been moving sideways for a period of time, so really sort of basing over an extended period of time. And interesting that over the course of the last few weeks, this is actually one I think from last week as well, that despite the market weakness, this has really started to move quite well. And again, probably more the fact that it's probably a defensive type of stock, but looking really nice in terms of price action. The on-stop order there at 37.96 with a limit to 38.15. Protective stop, making sure that we are at least 2 ATRs away and at least 0.5% below the most recent medium-term trough. Where is that trough in relation to the second from last peak? It's well clear of it. We do have a long-term peak over here, which we've already had our first test of, and looking really, really nice. Last week's candle as well, confirming some strength in it with a nice pin bar there. We just need to trigger that order. So remember, rather than using our what we've used historically has been the 2 pips, i.e. 2 cents above a medium-term peak, where the stock was value of $1 or whether it was $1,500, we've just changed that to 0.5%. So we're using a 0.5% rule instead of the notional 2 pips. So that was one from the previous week. So if we discard that, didn't find any in the US for this particular week. So those of you, if you managed to find something, please let me know. We'll go through and have a look at the ASX ones, and we'll come back and see if anyone's typed in any setups in the US. I can see a couple already coming through. In the ASX, there was 3 that we managed to find this particular week. So in no particular order, CKF, Collins Food Limited. Interesting that the 3-letter code for CKF, this company also happens to do Kentucky Fried Chicken. So it'd be interesting if the code for this company was KFC. Would that have any impact on whether you were going to purchase the stock, given that it produces fast food? I would hope not. But anyway, just a little quirk of I guess the way they name their stocks, rather than calling it KFC, CKF, just one of the fast food outlets that it looks after. In this particular example, if we just zoom out and see where we are, we're pretty much at all-time highs for this particular stock. You'll see that through the relative strength, that we don't have a long history of it, just showing that the stock's only been around for around about 4 or 5 years. Having said that, though, in terms of price action, it does meet the price action filter. Obviously, the reason that it came up on the scans was that it had all the 3 trends in the appropriate alignment: red above blue above green, red above blue above green. So short term above medium term above longer term, diverging, moving averages along the way. Relative strength certainly outperforming the broader market, which is always a positive sign. And those of you in Melbourne, if you picked up the Herald Sun on Friday, would have seen an article that I actually wrote about relative strength as well, and the importance of using that as one of your stock selection criteria. This particular setup, we need to just wait until we break our last medium-term peak, the last trough that has just formed and been confirmed by the last candle. We're now short-term uptrend. That last trough at or above the second from last medium-term peak, well clear above it. So certainly market not waiting for this stock to come back to previous levels before entering the broader bigger players in the market entering the market to bid it up. So on-stop order for this one at $3.59. That's actually 0.5% above our $3.58, which under the previous rules, less than 2 pips that would be, with a limit to 1% above our medium-term peak, so that has a limit to $3.61. Protective stop needs to be at least 0.5% below that last medium-term trough and outside of 2 ATRs, so that comes in at $3.12. So that's the structure of the trade. One thing you just need to bear in mind that's representing a risk on the trade of around about 13%, which is it's a little bit higher than what we might typically take, but that's more a factor of its general sort of volatility than anything other than that. So that's the structure of the trade on Collins Food Limited, CKF. So that's one of the three. And there's another two, and Darren's managed to find one of those other two, and hopefully beyond charts we'll swap over pages. I know it's thinking about it. So that's one of the other two, and there was another one. I wonder if anybody else has found it on the ASX. There we go, BLA, Blue Sky Alternative Investments Limited. So certainly in terms of what the stock's done of later times, you'll notice that we've had a period there of sort of sideways movement for a good couple of months. And the clue that this was about to start moving again was the fact that we had this higher trough formed before we broke out of this range. So again, from a technical point of view, that's always a really good sign to see the formation of those higher troughs. It's broken outside of the box, it's come back, it's retested the upside of the box, which again is a really strong sign. So this old points of supply are now starting to act as future points of demand. So certainly in terms of structure of the trade, we just need to make sure that that last trough is at or above the second from last medium-term peak, and you can clearly see on the chart there that it is. We just need to zoom out and see where we are in terms of market history. We're at, coincidentally, we're at blue sky. So from that point of view, we really just need to wait until we get a break of the last medium-term peak there. So again, an opportunity there. It coincided with $6 or very close to it. In actual fact, that high there is $5.98. So entering half a percent above that level, 0.5% of well, close to $6 really, isn't it? Is close to 3 cents. In this particular instance, we're not quite there. 0.5% above, we end up with an on-stop order at $6. With a limit to 604, and with a protective stop there coming in at $5.18. That's at least 0.5% below that last medium-term trough, and certainly well outside of 2 ATRs. Now, in terms of the structure of that trade, because of volatility, etc., along the way, we end up with a protective stop on there that's around about 13% away. 13.6%. So it's starting to get out there a little bit. Again, more a factor of recent volatility that it's really just had some increased moves through here. Nice big candle through there, just adding, just expanding that average true range over the last little period. That's the reason why we've got that slightly wider protective stop on that one. The other one that was on the list, and if my mouse would work, I might have to go and use the finger pad on my laptop. There we go, and the dreaded circle of the wheel of death, I think we call it. There we go. We'll go up and have a look at the very last one, and the last one, AMA. So let's just scroll out on this one and see where we are. Again, really nice price action on this. Not quite at all-time highs. We do have, way back in 2007, pre-GFC, we do actually have a long-term peak up here. So it's certainly a significant point at which the market really turned this around. You'll remember the GFC. the nasty part of the GFC certainly coming in well after this period. The nasty part coming in sort of through August, September, October time, but it's still, we do have a long-term peak there to be thinking about. So it's something that in the structure of this trade, depending on whether or not you're going to count that as being a relevant point in time, is going to determine whether or not you're going to take this particular trade. Because as I said, there is a long-term peak at 109, and in terms of the structure of the trade, whilst it's a valid setup in terms of price action is looking really strong movement through here, great outperformance. It's come back, it's only had a very shallow retracement, and last week was really very, very strong. The only downer, if you like, to this particular setup is that we've got that long-term peak at 109. So if I just go through and put that in, if Beyond Charts allows me to do that. So the actual risk on the trade, there we go. So if I can put that in there, 109. The actual risk on the trade, if we look at this, we've got a risk there of 10 cents. And then if we've got a long-term peak at 109, we've got a reward of around 10 cents as well. So we've got that one-to-one type of setup, but remembering that we've got that long-term peak in there. So we really need to take a 1% off that level. So you're just scraping out a one-to-one type of trade setup. Now, ideally, when we're looking to structure our trades, we really want to be looking for 2-to-1 types of setups. Now, I know in the past we've all discussed the aspects of taking a trade as long as you've got at least 1-to-1. If you've got if you've got a minimum of, or indeed a maximum of 1-to-1 before you get into a long-term peak, remembering that long-term peaks can certainly have an impact on the progression of your trade, then you are really doing yourself a little bit of a disservice, because the overall expectancy of your trading system is going to be based on average wins compared to average losses, and how often you're able to have winning trades compared to losing trades. And certainly your objectives is to have an average win over the longer term of getting closer to 2-to-1 rather than 1-to-1. So certainly whilst this does constitute a valid setup, scraping out 1-to-1 there, and the price action does look very, very good, certainly wanting to target those trades that are more 2-to-1 as a minimum compared to 1-to-1. So I hope that makes sense. Now, Ken typed in one from the US, I think it is, OSIS. So we might go across and have a look at that. OSIS. And have a bit of a look and see what that looks like. And I'm sure it'll come up in a tick. Gap up on AMA a couple of weeks ago was on, I think it was either on earnings or an updated forecast. So AMA, from memory, I had a chat with Jeff the other day about this, is a company that I think I'm right, is that it owns or runs a selection of like panel beaters, company that basically buys up panel beaters, puts them under their broader brand grouping, if you like. Obviously has some good relationships with insurance providers and those sorts of things. So OSIS, and you'll see there that I've got a bit of an annotation there on the chart. So I'll just go through and have a look at that. In terms of price action, yes, look, it meets all the price action criteria. The one thing that we need to think about as well is that whilst we could trade this, because we do have obviously good relative strength, whereabouts are we in terms of all-time highs? Well, we're certainly at all-time highs, which again is a really positive sign given the broader market moves. Now, certainly I don't have any problems if you were wanting to get into this trade above the last candle. Now, given that the last candle is getting close to being a pin bar, certainly it's got a lot of work to do to get up to that particular level, and quite often you'll find that Once the pin bar is broken to the upside, that you can actually get some quite quick movements. So any profit taking that was done at this particular level all of a sudden turns around and people go, well, Struth, why did I ever get out of that? That thing's clearly still moving in a very strong direction. A lot of white candles, so a lot of good qualities about this particular stock. What we need to keep in mind is that the strategy that we employ is a breakout strategy. So the question then becomes, how far past our breakout point do we allow a trade to go before we say, look, it's probably gone too far? And by too far, I really mean that it's going to spend a certain amount of energy to break past a medium-term peak. So obviously had a nice big breakout candle here. We didn't get to see a short-term uptrend prior to that forming, so that would have been certainly an aggressive entry past that sort of $80 level if you were going to take a breakout trade there and be a little bit more aggressive and not having that confirming short-term uptrend. Now that we've got this confirming short-term uptrend, then you could have certainly taken a breakout trade above the previous candle there. So the question is, how far past our medium-term peak is a fair and reasonable guideline to say, okay, it hasn't moved too far, I can still get in the trade. So remembering that we're allowing ourselves 0.5% leeway before we get into the trade, and we're also allowing ourselves a maximum of 1% above that medium-term peak, ideally in which to structure our trade. So we're still giving it a window in which to trigger. The question then becomes, well, look, how far past that window is still fair and reasonable to get in? Well, what you need to think about is, what's the overall risk on the trade, and how does that fit in with, our criteria of trying to keep our trades with a risk of around about 10 to 12%, on the upper side. Now, certainly this is in blue sky, so I think that's a strong element to the structure of the trade and getting into this trade. The fact that we've passed 80, which is a very positive sign as well, because what you tend to find is that stocks, particularly between 80 and 100, once they breach that, clear that $80 level, tend to find a bit of a vacuum almost all the way up to 100. So certainly it's not a bad situation to for this stock to be in. So hopefully that makes sense, Ken. Ken says, I bought it but have regrets. Oh, well, look, at this stage, I don't know necessarily at this point in time. It's still got very good relative strength there, Ken. The three trends are obviously in alignment. The other aspect about this as well, is that it's broken out of this previous area where there was certainly, a relevant history of overhead supply. That's gone now. Last week, candle wasn't the strongest, but as I said, 1 week doesn't make a trade, and I think you'll find that if there's some strength in this market this coming week and we get a close above this level, this could certainly move stronger to the upward side as any supplier in here realises that, what was the point of getting out there? Certainly some very big candles compared to what the market's done over recent times. So certainly, a lot of times when you're in trades, sometimes you get pipped into trades only for them to do nothing for the next week or so before the market reassesses them and continues to push them upwards in the appropriate direction. Let's go through and have a look at the portfolio for trailing stops this week in the ASX. There weren't any trailed stops per se. There was one stock that I thought I'd just bring up, Auckland International Airport, and the reason being really nice strong candle there last week. So certainly this has been a stock that you could have held for the last couple of years, and at no time has it closed below its trailing 3 ATR. It got very, very close on a couple of occasions, but didn't actually close below it, and has continued to move upwards and onwards despite all the market volatility, despite the fact that the Australian market has been more volatile than than the US market. So again, it just goes to show you just need to keep things simple, stick to your plan, and let the market do what it needs to do. In the US, certainly this has been a stellar performer over recent times. Even with that market volatility that we had, since that time, the end of August, this has just been screaming onwards and upwards, and as a result, has continued to drag its 3 ATR based trailing stop onwards. And so again, a series of successive higher closes is certainly performing very, very nicely indeed, ACGL. So hopefully some of you have been on that and continue to be on that following your rules and not second guessing what the market's going to do. Cintas Corporation, again, a lot of sideways movement for a period of time. So even though it was moving sideways, was still outperforming the market. So think about what the market has done during those periods of time, particularly of more recent times. And again, starting to show some really nice price action, formation of a nice higher trough, nice candle last week dragging up the trailing 3 ATR as well. MANH, another stock in the watch list. Again, nice candle last week, nice bullish candle, dragging that 3 ATR up as well. So certainly, since initially triggering at $52, had a price volume volatility signal up at around about 65, and a nice strong close above that previous level as well. So looking really nice at this point in time. So hopefully those of you that have been on this throughout this this trade are still in it and doing the right thing by your trading plan. Just a couple of other ones that haven't trailed the stops on these yet, but looking very close. EFX, a couple of two very strong candles, and last week almost pin bar on that last candle as well. That's not going to take too much upward movement this week to drag that 3 ATR up as well. And PGR was another one that's the encouragement award goes to. Again, putting in now creating a nice higher trough. Good candle last week, closing high. It has dragged that 3 ATR up, but at this point in time, we're still the controlling ATR, or the controlling stop is still our initial stop. But it's not going to take too much more. We get another candle like that this week, and then our 3 ATR line is going to start coming up past our initial stop. So they were the ones that were certainly showing some good strength last week, and again, evident by the nice histogram on that last period as well. All right, folks, that's about all I could find over the course of the weekend. As I said, it's taking a few weeks for the market to get its mojo back and for price action to start appearing on the charts in the right sort of patterns that we're looking for our trade setups. Any questions or any observations from the last week in particular? Can I get a bit of an indication as to those of you who have watched the education session last week? I know I had a couple of very keen members who are asking about the invitation on the Wednesday. Yep, fantastic, Ken. Thanks, Kay. Good, Keith. Great, David. Hopefully that's been helpful. Michael, maybe this week you can catch up with that one. I think the whole concept of pairing volatility in terms of what the market's doing, sort of upwards and downwards, and pairing that against some market risk is something that I think just helps you to give a broader perspective on the overall market, and really just gets you to think about that. We don't need to be in the market all of the time, and while sometimes you're going to find that when the market does go downwards, and if we just go back and have a quick look at those indices once again, that for a long period of time we were talking about the US market as an example being in this broad sideways moving market, okay? And at the same time we had this level of divergence, which really meant that whilst the market was moving sideways, our market risk indicator was starting to move to the downward side. Now, if you also pair that up with what's happening with our volatility, you'll start to see that volatility, even though we're going sideways, is starting to increase, i.e. the grass is taller than our little red line, so to speak. So certainly as we're getting into higher risk territory, we're getting a significant increase in volatility, greater than the historic volatility, so looking back over a 63 period time frame, and certainly starting to move even before we fell out of this sideways box. Okay, so pairing those two up, I think, is really useful. And the other aspect of it as well is to get you to think about, whilst we've moved down here and we've had some significant moves to the up and to the downward side, during this particular time frame, a lot of clients, particularly newer clients, are saying, well, David, when are we going to go short? And when you've got significant volatility, and remembering this is it's a long-only system using the weekly methodology, those of you who might be thinking about shorter-term trading systems, as an example, using it on daily time frame, when you've got this sort of volatility and we haven't got a fully entrenched bear market, whilst we are certainly bearish in that we are below our longer term moving average, and certainly things feel like they're more inclined to move to the downward side than the upward side, until we really start to get a series of sort of lower longer term peaks below this longer term moving average, from a shorter term perspective, you're really not going to be wanting to go short until you get that, because in between that time when the market's trying to make up its mind, you've got this significant volatility, and no sooner do you try and go short on a shorter term time frame, and you get these huge swings which come round and rip your head off. And so that's the sort of perspective, that's the sort of context that you need to be thinking about your overall trading, and not be trying to make every post a win. As soon as we get a change in market direction, quick, I've got to go short, only to experience and be a victim of that increased volatility. So hopefully that makes sense. So we just need to let the market tell us what to do, and we've got our indicators to help us do that at the same time. The other thing as well, just remembering, we're a trend following system, and the system works best when we have low volatility. So periods through here where you'll see volatility is much lower than its longer term moving average, and have a look at what happens with the market during that particular time. So that's the US market, nice low volatile market, and those stocks that have got good relative strength, they're really going to perform very, very nicely during those time frames. Some other times here when we start to move out of low risk, get into high risk markets, look what happens with the volatility. It's starting to increase as well. So there we go. Ken says there were some good short opportunities. Crown, far too late for them now. Yeah, well, look, I won't have a look at that, Ken, because I'm not really into the short term style of trading on the short side. You can have a look at that for yourself. Certainly, short-term trading is certainly much, much higher risk, and the reward, I don't think there's a significant increase in the amount of reward you're going to get from your short-term trading. The best time you're going to make money during your short-term trading is during a low volatile market, and when there's low volatility, guess what? You're going to make money with your longer-term trades. So just bear that in mind as you go through. All right, folks, thanks for the feedback today. I'll have to have a bit of a think about what I cover in the education session this week, but certainly, as always, if you've got any topics that you would like covered, certainly let me know. I'm still mindful of some of the newer members of the club as well, that there's a need from time to time to go back and readdress some of the earlier concepts, just to consolidate on those as well. All right, folks, well, look, you have a good week, and I'll catch up with you on the education session on Wednesday, if not Friday for the macro session. If not then, certainly this time next week. And Michael de Pellegrin, go and do your homework and catch up on your education sessions. All right, folks, see you later.